So I want to welcome you all in today's program on banking industry actually. But first of all, I want to request you all to raise for our institute motto, please.
यशस्सुप्तेषु जागृति यशस्सुप्तेषु जागृति देव
Please take your seat. So give us the knowledge about the correspondent banking industry, we have with us our faculty, CA Vijay Mandloi. And before that, I want to request our Vikasa chairman and RCM CA Ketan Sayya to say a few words to us, sir, please.
Thank you, Pinky Kedia, madam. It's a pleasure to be here in this wonderful session on correspondent banking and financial institutions coverage. In fact, to be very honest with you, a newer subject for me too. And I'm very glad that, Pinky had that courage to organize such a innovative topic so that we can have some new knowledge of some newer topic. Of course, as we see correspondent banking, basically, there are intermediaries who are helping out the banks or financial institutions in different countries to, execute the transactions, be it as may be. But I think, we are very fortunate to have the expert CA Vijay ji on this subject over here. And without taking any more time, I'll request our regional council member Chintan Patel from Ahmedabad to formally introduce Vijay ji. And once again, thank you to Pinky ma'am for giving me this opportunity. Thank you, all of you.
Chairperson of the committee and my council colleague, CA Pinky Kedia. My colleague in council is CA Ketan Bhai. The faculty of the session, C. Vijay ji. Seniors and friends, good evening all of you. First of all, heartiest congratulations to each one of you for being present for what a different innovative topic. Because when I just look at the topic, like Ketan Bhai mentioned, that it is really difficult to understand what is going to be content of the topic. And now, I understand there is always a lot of pressure from CP requirements, but in addition to the CP requirements, I think you have made a right choice to be part of this particular topic, and we have very good personality along with us. We is going to speak about this topic. Let me introduce Vijay ji. He is a May 2003 batch commerce accountant, 20 years of experience, and his experience is primarily with respect to banking. That is includes risk compliance management, risk, AML, credit, sales, relationship. And he has started career in Citibank in 2003, worked in commercial banking and transactions banking business, where he spent 12 years before moving to Wells Fargo in 2014. He's working with BNP Paribas since January 2019 as a senior relationship manager in financial institutions. So along with that, he also received a lot of awards and nominated to be the part of leadership program at the University of Washington, USA, where he was awarded as a best participant of award across 40 participants from bank across globe. So I'm very much sure that the person with having a lot of experience on banking, and one very important thing is that We all sometimes looking for a traditional area, and this is a non-traditional area which is not known by many. So if somebody take the risk to start with it, I think there are many who's going to support you, including CS. So good opportunity for all of us. With this, welcoming you to this pretty August gathering. Thank you so much. Before we invite him, one formality from all of us to greet him with a memento. I request the chairperson Pinky Kedia ji and Ketan Bhai to greet him with a memento. कोई बात नहीं.
Am I audible to everyone? So maybe I'll give you a quick perspective as to how come a guy who's never ever participated in any of such events is here taking a session. So I met Pinky ji couple of weeks back on a Saturday evening in a mythological play. I was sitting with the participants there, participant I think who had participated in that mythological play, and she asked me, "You played which character?" And I told her that I didn't play any character. I've just come here as one of the viewers of this particular program. And then my brother introduced me to her, and that's how we connected. In fact, Pinky ma'am's husband I know since long because I've interacted with him in the past, and during the conversation, she basically checked with me if I can participate or contribute in some form to our institute. And I was glad that after 2 decades, at least I've got this opportunity to interact with fellow members and share whatever I have learned over all these years in the banking industry. So maybe without taking much time, what I would like to take you guys through is something which is very, very unique in the banking system. Many men have heard about the terms correspondent banking, financial institutions coverage, and so on and so forth. But what happens is when I tell you that I work in a bank, typically the way one perceives me to be would be either I would be in operations or I would be managing SMEs, retail, or large corporates. Correspondent banking is something which is alien. It was alien to me also when I joined banking. I was, for good 7-8 years, I was part of commercial banking, meeting SME clients in the market. I was heading Mumbai, and we used to do a lot of SME loans for a lot of clients when I was with Citibank. So financial institution coverage was something which was very, very new to me. Even I didn't know what this topic is all about. And somehow internally within Citibank, I got an opportunity to move into corporate banking on the fixed side, and that's how I entered into the financial institutions coverage world. Typically, to give you some perspective, for me, my clients are banks in India. So I manage State Bank of India or State Bank group relationship. I manage RBI, ICICI, SDFC, Axis. So these are my clients, and many of you may kind of frown, saying, how can a bank be my client? Because typically a bank is always considered as a competition to another bank in the market, but this is what connects us, and it's a big business worldwide, not only in India, but banks do compete with each other when it comes to the commercial part of it. But internally, there is a lot of opportunity between banks, and bank is an important relationship for any bank across globe, anywhere in the world. So maybe before I start, I just thought while I was making this presentation in last 2 days, I just thought of giving you a perspective on the Indian economy. While I'm sure I'm kind of very junior, many may already know, you guys would have read it in the newspapers or you guys would have already seen it in a lot of media which is available, WhatsApp forwards. India is a big country. 1.4 billion population, GDP of $2.9 trillion. We are now the fifth largest. When this presentation was made, we were sixth, we are fifth, and hopefully we should keep climbing the ladder up with a 7% share in the world GDP. And India will become hopefully the third largest economy by 2030. And that's the aspiration with which I think our government is also working. The first trillion took almost 50 years, but going forward, it should take around 5 years to add 1 trillion in our GDP every year, every 5 years. The market cap of USD 3.46 trillion and expected to reach 5 trillion by 2024. Steady improvement in ease of doing business in India. G20 is kind of all about revolving around doing a lot of marketing, trying to showcase what India is to the international investors. Third largest unicorn hub. I mean, this is like a big surprise. Frankly, whenever we talk about startups within our bank on the floor, and I keep telling this to everyone that chartered accountants are the biggest startups one can think of. I mean, after qualifying as a chartered accountant, we all started up. I mean, many of us may not have had legacy of our parents who were chartered accountants having their own practice, and we just inherited that. But we all started up. We are all startups in some form or the other. So while the startup term has picked up pace in the last 5-10 years, but we are the pioneers when it comes to doing the startup business in India. Every practicing chartered accountant who would have started somewhere is a startup in himself. We are number 5 globally in terms of installed renewable capacity, largest capacity increase planned globally by 2030. So a lot of focus on sustainability, a lot of focus on reaching net zero in terms of carbon emission globally. While our aspirations are not in line with other European countries, but we are putting a lot of focus on trying to become net zero, trying to have a lot of policies in place. In fact, many of you may have seen that Reserve Bank of India has come out with one climate risk and sustainable finance discussion paper. And this was somewhere in July of this year. And they had sent this discussion paper open for public, where many banks, many foreign banks, many large corporates, they were asked to provide their feedback on what is expected from Reserve Bank of India in terms of reaching the sustainability goal, reaching the green goal, reaching the net zero carbon goal. So that is what is picking up pace. Moving to the next slide. So what is the role of bank in economic growth? Very simple. Banks traditionally used to take deposits from a lot of depositors, lend that money at a spread of 200, 300, 400 basis points, manage their investment book, and have profits. So this typically was the traditional conventional business model of the banks in India. But last 2 decades or so, we have seen banks really getting into too many niche products when it comes to global markets, derivatives, interest rate swaps, cross-currency swaps, and so on and so forth. So what is happening is, if you see, the banking is very simple. The role is to provide retail credit to individual customers, to provide business credit to SMEs and mid-market enterprises, large corporates, and help them increase their business. With the retail credit, there is an increase in demand, and that's how the overall economy grows. So bank has a very, very important role in growing the GDP of a country. And the services industry, the entire financial institution comprises of many institutions, not only banks, which we will come in our slides later. But the point which I wanted to highlight over here is that banks in any country adds a lot to the GDP growth of any country. So when we are targeting to become number 3, number 4 over next 5-7 years, banks will have to play a very, very important role when it comes to growing the GDP of any country. I mean, banks are called as the backbone of any country. And in true sense, yes, because bank really monitors a lot of fundamental, you can say the fundamental growth engines, the fundamental supply chain of currencies, and many more things for a lot of individuals and a lot of businesses in any country. What I'll do is, maybe if you guys have any doubt, any questions, we can take them along. If you want me to interrupt and if you want me to explain something in greater detail, I'm more than happy to do that. I know it's going to be little boring because it may not be your day-to-day subject, but the whole idea is, given that we are so active in learning amendments and knowing what's happening, and that's what is expected of a chartered accountant. I think this is somewhere going to help you when you interact with your clients, and your clients in turn are making those remittances, issuing trade LCs, and doing international trade. Because being a chartered accountant, it is imperative on us that we should know what our clients are doing with banks in the market. So to give you some perspective on the contribution to GDP as a service sector, the banking sector GDP is around 7.7% of GDP. So the banks contribute 7.7%, and 30% of the intermediate support which the banks give to the clients, to their own clients. So that's around 30%, and 1.5 million jobs or the employment opportunities which is provided by the bank. So banking industry is huge. If I were to give you some perspective on what the entire landscape looks like, I'll spend some time on this. So this is how the financial institution landscape in India looks like. Are you guys able to see it on the screen? Is it legible? Can you see the font, or is the font too small? Okay, so maybe I'll just go through it. The major players in a financial institution. So the business in which I am part of is called as Financial Institutions Coverage. It is called as Financial Institutions Group. In many Indian banks, it is also known as International Financial Institutions Group, IFIG. So these are all the terms for the same business that we run in a bank. Typically, the way it functions it is not only for a foreign bank to have this department. Many Indian banks, to name a few, State Bank of India calls this department as International Banking Group, IBG is what they call this group as. So they are my contact point when it comes to institutional level relationship. And ICICI Bank calls this department as IFIG, International Financial Institutions Group. Many other banks, for example, Axis Bank calls it as FIG, which is Financial Institutions Group. So the names may differ, but the business remains the same. The touch points remains the same. So my clients would basically expect services from me, and I would go ahead and give them the financial institutions products, which we will come at a later stage in our slides. So to give you some perspective, right now, you all may be aware that there is a spree of consolidation which has happened in the last 3 or 4 years in the public sector unit space, or the government-owned bank space. We used to have many banks, and since 2012, if you would have tracked the financials of the banks in India, we were really struggling on the NPA numbers, the gross NPA as well as the net NPA. There were few banks, I don't want to name them, but their gross NPAs were as high as 27%. And last 10 years has been quite challenging for the Indian banking sector from an NPA perspective. So government had no choice but to kind of consolidate, make few banks. I mean, if you see world over, there are 4 or 5 large banks which typically runs the banking industry in any country. Then there would be the regional banks, cooperative banks, and so on and so forth. But from a government-owned entity, it shouldn't be more than 5 or 6. As we speak, we have 5 major banks, which I have displayed. there are total 12 public sector unit banks in India. Their share at one point in time, maybe in 2010, used to be over 75%. Banks, I mean, at one point in time, they used to be 85, 90%. Private banks used to have zilch. They used to have very less market share. But just look at the market share, which has shifted from 85, 90%. Today, the PSU banks, the market share is only 58.5%. So that's a market share which SBI, PNB, Bank of Baroda, Canara, Union Bank, and many other PSU banks all put together have 58.5% market share of the banking industry in India. It's a big shift. There's a lot of competition. Private banks are really putting a lot of pressure on PSU banks to come up the curve, while they are still some time away in terms of improving their service levels, improving their product offering and delivery, but they are now pulling up their socks and they are really fighting a fierce battle with a lot of private banks in the market. To give you some perspective, State Bank of India has a market share of 25%. So if I remove 25% from 58.5, the remaining 11 banks have almost the same share as SBI has. So SBI has the lion's share in the Indian banking sector by miles. The second largest now after HDFC Bank and HDFC Limited merger would be HDFC Bank in the new form after the merger. They would be close to 17, 18 lakh crore. So HDFC Bank will become the second largest bank after SBI from a total assets perspective. If you look at the private banks, a lot of private banks, 21 private banks here compared to a PSU. So I personally feel that even private banks will see some level of consolidation over time, while they are currently doing good because they are eating into the market share of PSU banks. Plus, the market share in general is growing because of the Jan Dhan Yojana, which the government had implemented many years back. That has added a lot of accounts in the banking industry. More than that, what has happened is there is a lot of focus on digitization of payments, and because of which a lot of people like us in tier 2, tier 3 cities are now moving to doing their transactions digitally. Private banks are playing a major role in the digitization of the banking sector in India, and that's why they're getting a lot of market share. So the top banks from a private bank perspective would be HDFC Bank, ICICI, Axis, Kotak, and IndusInd. And then there are a host of other banks who would fall in this category. So 21 private banks. Coming to foreign banks, there are many numbers. They are almost more than double of the private banks in India. There are 45 foreign banks, but with a market share of only 4%. So 58.5 is PSU, 37.5 is private. Private bank has gained the market share 10 years back from 10-15% today to 37.5. And that has been a phenomenal growth for the private banks in India. And this is evident from the fact that the share prices of all private banks, if you see in the last 10 years, they have done reasonably well because the fundamentals, the growth quarter on quarter has been tremendous. Coming to foreign banks, only 4%, but 45 foreign banks. When I go to the slide on correspondent banking, I'll tell you why 45%, why only 4% market share. This 4% market share is not a true picture of the revenues what a foreign bank would be earning, because this 4% is only the domestic business which a foreign bank would be doing. But foreign banks do much more than only targeting. Foreign banks will never ever get into a retail banking business. I mean, if you look at Citibank has sold their retail banking franchise to Axis Bank. And you will see a lot of foreign banks. I mean, I have at least seen in last 3 years, many foreign banks are shutting their shop and moving out of India because it is becoming incrementally very, very difficult for a foreign bank to manage or to comply with all the increased regulations and compliance. I mean, not only chartered accountants while practicing are facing the heat, but a lot of banks are also facing a lot of challenges when it comes to compliance, when it comes to AML, and when it comes to just implementing various types of regulations, not only from Indian regulators, but from overseas regulators as well. So the top banks from a foreign bank category would be Citibank, HSBC, Standard Chartered, Deutsche Bank, and BNP Paribas. I work with BNP Paribas, and it's a French bank. I used to work with Citibank, which is a US bank, for around 12 years, and then with Wells Fargo. Wells Fargo has shut its operations. It used to be a rep office. Bank of New York is kind of on the verge of shutting down its operations. Rabobank is shutting down its operations. A lot of Canadian banks are shutting down their operations. And they are either in the form of rep office, a representative office, which is more like a liaison office. They are not supposed to book any asset onshore. So everything that they do is all offshore. So a liaison officer would be somebody who would go meet a client, meet a bank, and if there is any business opportunity, he will just pass that business to their regional office or the head office. So far, so good. Everyone with me on the same page? Any doubts, anything that you would like to ask? So this is how the banking landscape looks like in India. This is banking. The financial institutions coverage is a bigger umbrella. It's a much bigger umbrella. And with the advent of fintechs, with the advent of small finance banks, with the advent of a lot of fintechs, this space is just growing disproportionately at a very, very rapid pace. So going to the second segment, it is the insurance segment, life as well as non-life. Again, if you see LIC, Life Insurance Corporation of India, because of its monopolistic position, was a market leader for a long, long time. It still holds a lion's market share, but facing a lot of heat when it comes to other private players like HDFC Life, SBI Life, Tata, Kotak, Bajaj, Max Life, ICICI Prudential. So if you see the insurance segment, the traditional insurance is again seeing a complete paradigm shift from the traditional LIC products to a lot of Indian banks partnering with foreign financial institutions or insurance companies and giving and selling insurance products. I mean, why are they partnering with foreign players? On two counts. I mean, most Indian banks really don't need capital. They have ample capital. They look at partnering with the Max Lives of the world, or for example, SBI Life had partnered with BNP for 26% in 2001. We eventually exited last couple of years back, but to give you some perspective why somebody partners, they partner with an insurance company for the technical know-how for products, because somebody is ready to put a capital, but not many know how to run a life insurance business in India. So if you look at the insurance, it falls part of the umbrella of financial institutions coverage. Coming to non-life, again, private and public, more or less half-half. The AUM is of 51 billion euros. I mean, €1, I typically, can I assume everyone will understand what is $1 million and $1 billion? Anyone who doesn't know, maybe I can just simply explain in less than 15 seconds. So frankly, we don't really take crores, lakhs when we are in our bank. Typically in a French bank, I will only talk about euros. In US banks, in my previous roles, I was only talking about dollars. So the thumb rule or the benchmark is very, very simple. 8 crore rupees. I'm just saying ballpark. I don't know what is today's exchange rate for euro or dollar. If it is 80 rupees for $1, then 8 crore is $1 million. It's as simple as that. 8 crore is $1 million. And if €1 is 80 rupees, the same number, then €1 million is 8 crore rupees. Understood, everyone? Now, what is 1 billion? 1 billion is 8,000 crores, is $1 billion and €1 billion, assuming that €1 and $1 is 80 rupees. That's a simple way I remember whenever I do a calculation, and if some senior asks me a number, what is the capital of SBI today? and I have to respond to him on email without even blinking an eye. I just divide it by 8 and I arrive at either millions or billions accordingly. So for example, if SBI has reported a profit of 24,000 crores for the first 6 months of this financial year, they have reported profits of how many $billion? So $3 billion, 8 threes are 24, correct? And if I were to really look at converting that into, suppose if they have reported a profit of 4,000 crores for quarter ending December 2022, how many $1 million they have reported? 4,000 crore would be how many $1 million? 500, because 8,000 crore is 1 billion. Correct? So $100 million is 800 crores. Simple. I mean, that you maybe keep only one calculation in mind and you will never forget this. So 8 ka aakada is something which you should keep in mind, and that's ballpark gives you the exact calculation. Coming to non-life, SDFC Ergo, Oriental Insurance, Bajaj, GIC, and all these are institutions which are kind of quite focused on the non-life insurance. ICICI Lombard is also very active. But if you look at the pie chart that I have shared, in a non-life, it is more or less 50-50, PSU as well as non-PSU, private and public. But in life, the public is a lion's share. Okay, if I were to tell you the exact number, it is 71% and 29%. At one point in time, LIC used to be close to 100%, but it is losing its market share. Again, to private players, maybe 5 years down the line, 10 years down the line, when we will see how this landscape has changed, it will exactly be like banks, where the private players are eating into the market share of public sector entities. So public sector entities need to really do something, pull up their socks and ensure that they don't lose market share. Because you lose market share in 2 ways. 1, you're losing your existing business. 2, you're not capturing the incremental business in the same proportion that a private bank is capturing. So these are the 2 ways in which you will lose your market share. So that's on insurance. Any questions, any thoughts? I mean, it can be a thought also if you guys have anything to add, because I'm not an expert in this field. I mean, if you can just look at all the names here, I don't think my lifetime will be enough for me to learn, understand anything here. So if anyone has any thoughts which can be shared with our friends here, our members here, more than happy. If there are any anecdotal, any data points that you would like to share with the participants here, it will just make this entire discussion very, very interactive and very lively. So I'm requesting, if there are any thoughts any member has, please feel free to add here. Coming to the third segment is NBFC, non-banking financial companies. Now, NBFC is typically into 2 segments, largely I'm saying. One is housing finance and the third is consumer finance. SDFC Limited, if I were to give you some top line balance sheet number, SDFC Limited, which is the parent, Deepak Parekh used to be the chairman many years back. Now he's a non-executive chairman there, and it is one of the best companies in terms of valuations, in terms of the financials, fundamentals in our country. SDFC Limited is close to 6 lakh crore balance sheet size. So that's the number which I wanted to leave with you. If I were to look at LIC Housing Finance, LIC is somewhere 2.5-3 lakh crore balance sheet, the total outstanding in terms of the loans that they have given. Canpin Homes, a small entity, it's a subsidiary of Canara Bank. Their top line is close to 13,000-14,000 crores. Then PNB Housing, it used to be 1 lakh crore in terms of the outstanding. It has now dropped to 65,000 crores. So those are the main players in addition to the banks. So if I were to give you some perspective, many banks do housing finance business within the bank. You're getting the point? But many entities have carved out a separate entity only to focus on the housing loan business. Because it's a very simple business. Typically, the way a housing finance company will function is they will have two client base. One would be the retail customers to whom they will give home loan or mortgage loan. They will give, so their customers would be either self-employed or salaried. I hope you're understanding what I'm saying. And the second would be the developers, the real estate developers. They would give them wholesale banking loans so that they can construct and then sell it to various individuals. And that's the traditional way of running a housing finance company. So far, so good, everyone. Coming to consumer finance, so that has again picked up quite well in the last 8 to 10 years. And the giant is Bajaj Finserv. It has from nowhere, maybe last 7-8 years back, has really captured a lion's share when it comes to consumer finance. So they are present in segments like if I want to buy a fridge, Bajaj will give me a loan. If I want to buy a mobile phone, I go to a Chroma or a Vijay Sales or to any other Kohinoor, Bajaj Finserv will support me for my personal loan requests. So consumer finance in the last few years has really picked up pace because what happens is they have really cut down on their turnaround times to process a loan. Many entities have come out score-based lending. So even without you giving them any documentation, just by doing a simple Google on your name, they can reasonably figure out how good or bad you are when it comes to servicing the loan. Shriram Transport, again a brilliant NBFC, 1 lakh crore, they just got merged. There was a merger which happened in Shriram Transport. So 1 lakh crore plus top line entity. You know what they do, very, very unique. So there is no direct competition to Shriram Transport. The competition is unorganized sector. So Shriram Transport is in the business of financing second-hand trucks to somebody who's a first-time borrower. So this guy is a driver with a truck company who is into transportation. The guy aspirationally wants to become an entrepreneur, like most of us would like to. So if he wants to become an entrepreneur, nobody will give him a loan because what happens is typically his salary would be what, 20-25,000 a month. So he would never be eligible to finance a truck that he aspirationally wants to buy and become an entrepreneur on his own. Shriram Transport funds such customers. So they are actually adding a lot of social value in the entire economic chain of the transport industry. So they will give money, 5 lakh, 6 lakh, 8 lakh for a second-hand truck to the first-time truck driver. And their processes, their controls, their collection is so strong that if the guy is taking the truck from Delhi to Kanyakumari, they exactly know where the truck is. And even if there is a delay, they will recover their EMI. So Shriram Transport is into the second-hand truck refinancing, and they really make somebody who is a salaried guy with a transport company, and they are creating a lot of entrepreneurs. So this guy has a truck and he is now earning 1 lakh rupees a month because he owns the truck and he's not a salaried guy anymore with anyone. HDB Financial is again into SME business. They are also into affordable housing. It's a subsidiary of HDFC Bank, not limited. So HDB Financial Services is 96% owned by HDFC Bank, 4% are the ESOPs within the senior management of the bank, and their top line is close to 60,000 crore. So they basically target the SME and the housing finance, to an extent the mortgage side of it, not exactly the housing finance, but the mortgages. If somebody really wants a business loan by mortgaging his collateral property, I mean, they are into that business, and they're also into personal loan business. And the last is Kotak Mahindra Prime. You may have heard this again. I mean, it's a separate niche which Kotak has created for the four-wheeler loans, which is very, very old. So Kotak Prime, I know when I was searching for a job after I cleared, I had got an offer from them. So they are a very old, you can say, the motor vehicle financing company. Any questions so far? So these three banks, insurance and NBFCs are all part of financial institution coverage. Coming to others, I mean, they're the three main, you can say, pillars of the financial institution coverage in any country. The fourth one, which is picking up or which has picked up pace considerably, is the asset management, the mutual funds. To give you some background, mutual fund in India used to be close to 25 lakh crores. If I were to give you a perspective, close to 250, $300 billion AUM, which is asset under management. 5 years back, thanks to COVID, people have started putting more money in mutual fund because they had surplus. They didn't know what to do with that money. We couldn't go out for our vacation, family vacation. We couldn't go out in restaurants, splurge money. We couldn't go out on weekends to have breaks. This industry has grown exponentially. The number today is 40 lakh crores. So just imagine the pace at which the mutual fund is growing in India. All with me? A 40 lakh crore is $500 billion. A $1 trillion, it is short of 500 more. So $1 trillion would be $1,000 billion, would be $1 trillion. All with me? Clear? So $500 billion is the total AUM under management of mutual funds in India. The largest mutual fund is SBI Mutual Fund. They have close to 6-7 lakh crores asset under management as on date. And it's huge. Going to the other names, it is ICICI, SDFC, Kotak, Aditya Birla, and Reliance. The total AUM, it shows 470, but as on date, it is 500 billion. 51 asset managers in the country. Top 6 AMCs constitute 63% of the total industry AUM. So you can imagine the 80-20 Pareto. So the top 6 almost runs the country when it comes to mutual fund business. And the remaining are very, very small. But in terms of numbers, there are 51 asset managers, there are 51 mutual funds which are doing their business in India. So for example, BNP Paribas has recently tied up with Bank of Baroda, where Bank of Baroda has 51% share, we have 49% share. It's a 20,000 crore AUM. I mean, we are frankly nothing when it comes to 40 lakh crore of AUM. Any queries, any questions? Just to give you some numbers on life and non-life, I don't know whether it is visible or not. There is one public, which is LIC, and 23 private players. LIC dominates market with 71% market share. Non-life, 51 billion AUM, 6 public and 28 private players. GIC Re is the sole national reinsurance. General Insurance Corporation of India Re Insurance is the sole reinsurance entity of India. In terms of housing finance, to give you some perspective, large players like SDFC Limited market cap of 55 billion, LIC Housing market cap of 2.6 billion euros. Large players, Shriram Transport, 4.4 billion. So again, there are multiple players in NBFC. NBFC is endless list. I've just given you the top 4 or 5 names. Asset management, I said, 51 mutual funds running the entire show in India, but the top 6 is almost 63%. Coming to custody business, again, a very, very unique business and very, very dear or very close to a lot of foreign banks' heart, because a lot of global custody business is typically managed by a lot of foreign banks in India. Citibank is one of key players. Deutsche Bank, HSBC, they are the strong players when it comes to the global custody business. So this is basically somebody who wants to do investment in India from overseas, and if they are our client, they would typically give us the local custody, but it is called as global custody business. And then there is a domestic custody business, which typically is managed by the private players in India, the private banks in India. So Kotak, ICICI, they have their own domestic custody business. So to name a few, stock holding, JP Morgan, Deutsche Bank, DBS City. SBI has a partnership with SocGen, Societe Generale Bank. It's again a French bank. SBI SG is the are four, and Indian banks are six. The share is roughly 50, 40, and 10 in the industry of assets under custody of these custodians. Broker dealers, most of you may know, I will not really spend much time there. Edelweiss, Motilal Oswal, Sher Khan, IIFL. Sher Khan is a 100% subsidiary of BNP Paribas bank. We bought this entity in 2017, so it's a 100% subsidiary of BNP, and it's into the retail broking business. Pension plans, LIC, UTI, HDFC Pension, and SBI. Private equity, something, again, not many of us may know, but they are really investing a lot of money in India when it comes to doing private equity investments in the real estate business or looking at opportunistic investment in any large corporates or in any M&A business opportunities. KKR, CVC, Bain Capital, Warburg Pincus, Carlyle, Blackstone. I mean, there are many private equity players who are very, very actively looking at investing in India on many counts. India is now comparatively much stable. The inflation that is in double digits in many countries, including Europe and US, in India, it is single digit and going down. And there is a lot of positive view on investing money in India. So if you see a lot of activities happening, for example, when BNP sold its stake in SBI Life, Carlyle Group was the one who bought it from us. They are the hedge funds. So the hedge fund entity kind of bought it, and within 9 months, they sold it, made some 40-50% profit on a huge investment of close to $1 billion that they did. So it's high risk, high reward hedge fund business. Now, new age banks, the small finance bank. So AU, Ujjivan, Suryoday, Equitas, ESAF, Jana, they're all small finance bank. SFBs is what we call them. You would have really seen these very, very prominently now because they are now increasing their footprint. They are increasing their visibility in various markets. To give you some perspective on how the small finance banks came into existence, there is microfinance institutions. Are you guys aware about something which is called as microfinance institutions? Have you heard about MFIs, microfinance institutions? So microfinance institution is again something which I manage as a portfolio. There are many microfinance institutions. Their top line, the largest is Grameen, which is Bangalore based. So Grameen has a top line of around 16,000 crores. And then the second largest would be in the region of 7 to 8,000 crores. To name a few, Annapurna, Fusion Microfinance, Arohan, then many other light microfinance and so on and so forth. They are all in the business of providing microfinance to women entrepreneurs in this country. So they have two business models with which they lend to women entrepreneurs. The cause is very social. The ticket size typically in a microfinance institution is 25,000 to 75,000 rupees. There are two business models. One is the joint liability group model and one is the self-help group model. So what they do is the model is very, very unique to MFI. This was started by a gentleman by the name Mohammed Yunus in Bangladesh. He is the guy who made MFI, microfinance institution, very, very popular around the world, not only in India. But now if I were to look at the business, India contributes almost 50% of the end beneficiaries when it comes to microfinance institutions business around the world. So not that poor people are only in India. Microfinance institutions are there in US. Microfinance institutions are there in Europe. They are there in Southeast Asia. So they are spread across globe. But the number of people whom we touch as microfinance entities is just phenomenal. They contribute almost 50% of the total end beneficiaries who receive funds from the microfinance institutions. So in a joint liability group, JLG is what MFIs call it. What they do is they make a group of 5 to 8 women entrepreneurs. They typically wouldn't have made it to earning money themselves, but thanks to microfinance business model, what they do is they fund a 50,000 or a 75,000 to 6 or 8 women entrepreneurs with a joint and several liability. I'm sure you would all understand, we would have learned it in our law, what is jointly and severally liable. So the joint and several liability is something which I am responsible if one borrower from that group fails to pay, the entire group is responsible to ensure that the EMI is paid on time. They work on weekly EMI, fortnightly EMI, monthly EMI business models. The AUM, the asset under management of microfinance today is close to 150 lakh crores. So 150 lakh crore is the overall 1,50,000 crore, I'm sorry. 1,50,000 crore is the total AUM of microfinance institutions, and that's huge. And that's growing at a very rapid pace. The good part of MFI is that they don't compete with anyone. They are playing in the villages, the remotest part of villages where there may not be electricity. And the women entrepreneurs who borrow from microfinance institutions, they use this money for handicrafts, for doing some artisan work, for doing some pottery, or there may be a vegetable vendor, or they may have a small kirana shop or a general store shop, and they are kind of managing the business by borrowing from MFIs. Microfinance institutions charge close to 20 to 25%. But again, the ticket sizes are very, very small. So it's high risk, high reward business. They have NPAs because people typically may not pay. COVID, they had faced a lot of challenges, but somehow the industry survived. They've gone through various credit cycles. In 2011, there was Andhra crisis, where the government said that no need to pay because few women committed suicide. Demonetization was one such wave. Post that, COVID was the other wave. So this business is very, very prone to a lot of credit cycles, which you may have seen over time, but they have survived. And now many microfinance institutions are coming out with an IPO. For example, Annapurna Microfinance, Fusion Microfinance came out with their IPO last month, and it was successful. They were oversubscribed 2.3 times, and they have listed their entity. It's a 7,000 crore AUM company. The last one are the payment banks, Fino, Paytm, Jio, Airtel, Idea, ICICI, Vodafone, sorry. So the pension plans is what I have mentioned. If you see, I mean, typically it would be somewhere as a part of pension plans, but PF, I have kind of kept it out of financial institutions coverage because typically what happens is, so there are private trusts of various entities which manage provident funds of their employees, or otherwise there is EPFO. Now you can put money of your provident fund in mutual funds also, provided it is internally approved by our management. So large portion of like SBI mutual fund manages the provident fund of large foreign banks like JP Morgan. And they have approached us. If our employees provident fund, we have our own private trust where we invest. So typically, this is all privately managed. It's not, while it may be a financial institution from a definition perspective, but it doesn't come as something which I will manage as a relationship. So, I mean, see, the list can be endless. That's what I'm saying. So technically, correct. So the landscape is unending is what I'm saying. I mean, tomorrow, if, for example, home credit, I don't know, many may not have heard about home credit. So home credit is a European-based entity. They had a top line of 10,000 crore. They wrote off 3,000 crore during COVID. They had to get capital. Company is a global company. Their business model was they were giving personal loan to first-time borrower. Very, very unique business model. So if suppose I am going in a shop, I want to buy, and their ticket size was 10,000 rupees or 12,000 rupees. So again, that will somewhere come in the consumer finance segment. There is no collateral. It was purely on the basis of scoring based model. So they would look at your Facebook post, they would look at your Instagram post, and they would figure out something about your net worth. And I don't know how, but they had these score-based models which they had created, very unique business model. But they fell flat on their face because COVID just wiped in everything out of their balance sheet. Because you are lending to somebody and the collection model was also not in place. They were all waiting for people somewhere in some remote part of India. You would lend them online. You have not even met him. You're getting the point. I mean, things are really changing for good, for bad, I don't know. But the traditional way of lending, borrowing is all undergoing tremendous change. When it comes to fintech, a lot of fintechs also would be a part of financial institutions landscape. Frankly, I haven't really put them, but a fintech, for example, somebody who is supporting a financial industry, the APIs which they may be making and selling it to a bank, technically they are dependent on financial institution. So for example, there was Pine Labs, for example. I would technically classify them as a financial institution because their client base is banks and other financial institutions. Fortran is one such entity, which I would classify as financial institution. I mean, it's little gray area right now. So what is happening is a lot of these fintech companies, it will be very difficult for us to classify them as a financial institution or not as a financial institution. For example, Pine Labs, whenever you would have gone for shopping, you would have given your card, you would have seen a Pine Lab merchant ME machine, merchant establishment machine, correct? So traditionally banks used to have their own machines. I mean, I've worked in Citibank in that department. It used to be called as ME department, merchant establishment department, and it used to be a nightmare. If the machine, typically you used to get the billing, you used to get money. So the guy will come, there was intercharge. So typically there were multiple banks involved. Machine will belong to Citibank, card belongs to HDFC Bank. So ultimately HDFC Bank is taking a call on the card holder, correct? You're understanding what I'm saying? So if you are having a HDFC Bank credit card and you're swiping it to buy a shirt worth 5,000 rupees, HDFC Bank is taking a credit call on you, not Citibank. But Citibank ka machine hai and Citibank's current account will get credited of that merchant who is holding that account with Citibank. But for swiping, Citibank would basically share something back with HDFC because HDFC Bank is taking that call, correct? So somebody needs to make money in the entire chain. And that used to be close to 1.8%, came down to 1.2%, now 0.8. I don't know what Pine Labs is doing now, but Pine Lab has just killed that market. Pine Lab is saying that my machine, one, it is very, very cost effective. Two, it did not really bother about which machine, whose card. You tell me which bank you want me to connect this to and I'll connect it. So that monopolistic situation which prevailed 20 years back in the market, that Citibank machine hai, they will ask you MX nahi chalega, MX ke liye other card hai, and many more things, that this card will not go on this card. Nothing is kind of prevalent now. Everything is now on Pine Labs. So it's on tap and so on and so forth. So all of that is kind of evolving quite rapidly. Any comments, anyone on this slide? I have taken kind of considerable time because I really wanted you to understand what is my target market. So this is my target market. This is anyone who's working in a financial institutions coverage business in any bank. This typically is a target market for them. I'll come to products later as to what we do with them so that you get a perspective as to what are the business opportunities as a bank with other banks. Sorry, you had a question. Absolutely, yes. Absolutely, yes. Frankly, I'm saying that this is limitless. I mean, whatever you can think of has a financial industry connect should be a part of the landscape. And it's only evolving. Frankly, these last two, Payments Bank and all, if somebody would have seen this presentation 5 years back, those two names wouldn't have been there. But just that things are evolving so fast. In fact, microfinance, I haven't put it here. But microfinance institution is a financial industry. They are part of financial industry very much. Clear? Can I go to the next slide now? Any comments, any questions, any thoughts on the financial institution landscape in India? Anyone, any comment? Or if you can add some, please. again, so cooperative and all, I'm not even considering, because if you see 58.5 plus 37.5 plus 4 minus everything else will be cooperative banks and many other unorganized financial sector. So Saraswat Cooperative Bank, Cosmos Cooperative Bank, your Citizen Cooperative Bank, all of that also will have negligible market share. But to give you some perspective, Saraswat I used to manage as a relationship earlier. Saraswat Cooperative Bank had a total balance sheet size of 50,000 crore. They were larger than RBL Bank at one point in time. So not that they are not doing good business, but it's just that cooperative banks in front of a 1 lakh crore banking industry, they are nothing. I mean, it doesn't even constitute as a component. But you're right, it should be a part of this landscape. The cooperative banks, the regional rural banks, Thane Sahakari Cooperative Bank, and so on and so forth. It should. Any other thoughts? And why we haven't put that segment here is because it is not covered by financial institutions coverage. Well, while there are few foreign banks who deal with them, I used to deal with them, but the moment that cooperative word comes, credit becomes very, very wary of onboarding them as a client, because one, lot of frauds, lot of anti-money laundering issues. I mean, you would have seen how people have lost their money. A lot of cooperative societies who had put money in the bank which went burst. I think Thane Cooperative, PMC. So I think that's the reason I haven't put it intentionally, because it just doesn't make sense to kind of keep them here. Well, there are few exceptions which I have already mentioned. Who are they? Any other thoughts? Any other queries? Anyone? So it's all licensing. RBI will give a small finance bank license to an SFB, and it will give an NBFC license to an NBFC. The differentiating factor would be not all NBFCs are allowed to accept deposits from retail investors. An SFB exactly works like a bank only. But what is happening is, to give you, given that you have asked that question, SFBs, while thoda josh mein aake they all took license, bank license le liya, but now they are supposed to meet PSL requirements. They're supposed to meet SLR, CRR requirements. Wo kahan se aayega paisa? And the funny part is, will you ever put your money in a fixed deposit with an SFB? I mean, you may think twice. While they are not bad, okay, but if you have surplus money, you would typically put it in a GSIB is a term I'm sure many of you may have heard. Globally systemically important banks, GSIBs. RBI has classified only 3 banks in this country as GSIB, which means if these banks go bad, RBI will ensure that they don't fail. They're too big to fail. SBI, HDFC, and ICICI. These are 3 GSIBs. Otherwise, your money as a depositor is guaranteed by the state, by the government, only up to 1 lakh rupees. There is a talk now that they will increase it to 5 lakh rupees. Or is it already done? I'm not sure. Okay, then it is up to 5 lakh rupees. So from a deposit perspective, as a depositor, up to 5 lakh rupees, your money is guaranteed. Beyond that, it is not. Coming to SFB, SFB are struggling. I'll tell you what SFB business model was before they became SFB. Most SFBs were microfinance institutions. They grew quite significantly, quite substantially. Somebody like us, our investment banking team would have gone ahead, met the owners and would have told them, boss, you guys are doing so well. Please become bank and you will be in the league of SBI tomorrow. I mean, somebody would have shown them that that Chantare, that dream of becoming a very strong bank in the market. But what typically happens is a banking industry, on one hand, if you are saying consolidation, on the other hand, if a microfinance wants to become an SFB and wants to attract depositor money, it's very tough. I mean, how would typically an SFB attract depositors' money? Tell me if anyone has any thoughts. How can an SFB? That's it. There is no other option. There is no other option. They pay 9% on your fixed deposits. There is no bank in the market which is paying 9%. If I were to look at investing in mutual fund, if my mutual fund is giving me say 10, 11%, 12% return, I'm happy to put that 9% in an SFB. But I would not put all my eggs in one basket. I would try and diversify my portfolio in such a way that SFB I'll put maybe a few lakhs just to get that 9%. But they're not getting deposits. And that's why they're struggling. In fact, they come to banks like us. "Hey, can you please fund us, INR? Can you give us loan?" So an SFB, typically it's under the banking license that they're running a, so they're bank. It's just that they're termed as small finance bank, SFB. But they're practically, for all practical purposes, they're a bank in this country. And an NBFC need not really go through all the banking regulatory requirement which a bank would otherwise typically have to do. That's the difference. But all are licensed from RBI. Any doubts? Any other thoughts? Can I go to the next slide? So this is today's chart that I have just blindly pasted to give you some perspective how the total asset in the banking industry looks like. On your left are all the public sector banks, 12 remaining right now. On your right, well, I would technically not classify IDBI as a private bank, but by virtue of government reducing it below 51% and LIC coming in, they are qualified to be a private bank, but they are not. I mean, if somebody were to ask me, they are still a PSU bank because LIC and government both put together have a lion's share. They are not getting investors in the market to divest. So SBI, just look at the asset size, 50 lakh crore, huge, with a 25% market share in the country. Next comes HDFC, 20 lakh crores. Then comes ICICI Bank, 14 lakh crore, PNB 13, Bank of Baroda, Canara, Union, and then comes Axis. So that's the order of the top 6 banks in the country. And then you look at the private banks down. I mean, Suryodaya with a 8,000 crore asset size, I mean, it's no comparison. I mean, that's what the small finance bank I was just mentioning to the gentleman here, that the small private banks are just not there in the landscape. Where is 8,000 crore and where is 20 lakh crore? They'll take decades to reach there. And we're doing right things and at right time. Any questions or queries here? This is today's, so please don't look at those last price, percentage change, gross block and all. I mean, that's all came when I was pasting it on the slide. But what I wanted you guys to see is the last column, which talks about the total asset. So SBI, HDFC, PNB, Bank of Baroda, ICICI, and then below all these Bank of Indias of the world are there. Any comment, any thought on this? And this is post the consolidation process. Earlier, there used to be many more PSU banks, Syndicate Bank, Allahabad Bank, and I mean, there used to be like just too many. So SBI in 2017 merged their 5 associates when Ms. Arundhati Bhattacharya was the chairperson, and that merger happened. I mean, that was a very simple merger because they were all on the same platform. It was very simple, 100% subsidiary of SBI, but the others were forced by the government. So many challenges. It took like between 6 months to 18 months for these banks to do the entire consolidation because different systems, and it was nightmare. But finally, they have kind of completed that entire consolidation process. Any thoughts here? No, it will still be lower than SBI, but it's a big threat to SBI now. It's a big threat to SBI. Maybe if, I mean, HDFC when Mr. Aditya Puri was the MD and CEO, there was not a single quarter that they reported profit lower than 30%. And that used to be the benchmark. All investors only used to look at 30%, say, come on, the market will fall. So somehow they used to manage 30% quarter on quarter growth. But now they are the biggest threat to SBI. In future, they will go through some challenges now. They are yet to complete their merger process with HDFC Limited. HDFC Limited is a 6 lakh crore balance sheet, which will get merged into the bank. Bank is much bigger. So it is like little ironical situation where the parent is smaller in size compared to its own subsidiary. So it's more like a reverse merger which is happening, and they'll face some challenges because they will have to raise 60,000 crore worth of capital for a 6 lakh crore balance sheet. Why? Because CRR, SLR will come into picture. Your PSL requirement will come into picture. All that requires capital. I think they just wanted to kind of make one entity from an ease of operations perspective. And this gives a lot of value to the franchise. So what typically would happen is a bank, if you would have seen Mr. Deepak Parekh or their new MD CEO talking on this and why they did this, it was there in their agenda since long. In fact, market had no clue about it. When we got a call from SDFC that tomorrow morning we are going to do something like this, they said that there is some merger we are doing with an NBFC. They didn't even tell us that it is SDFC Limited, their own entity. And we are putting your name as one of the banks who would kind of help us in this process. So they have taken the entire bank in the country. I think there are 24 banks who are part of this process. 12 will be on SDFC Limited side, 12 will be on the bank side, and we will try and get investors for them. That's the process. So the real reason for them was a bank can raise capital at a much cheaper price compared to an NBFC. Okay, so the whole thought that they had in their mind was twofold. See, one, Mr. K.K. Mistry, who is the senior guy in SDFC Limited, he would have retired or he's already retired, maybe a couple of years from now. So many things may not be in the newspapers, but succession plan, who will run that business. And it's just becomes easier to consolidate. Frankly, if you see why consolidation is happening, I mean, the entire financial sector is kind of taking a full 360-degree turn and coming back to what we were doing many, many years back. I mean, focus. Correct. So there were regulatory challenges, and that's the reason they had to kind of do this. It was there in the radar, and it just gives a good value. 1 + 1 is always 3 from an investor perspective, because a large balance sheet will command better pricing. That was their thought. Because if I go in the market to an investor, a foreign investor, not an Indian investor, and if I'm raising money in the bond market, typically if they look at my size, they would really give me a better pricing compared to what typically a small bank like maybe an ICICI or an Axis may get now. The bonds? Correct. The limited, IDFC did that. IDFC Limited did that. So they just all became bank. ICICI was also 1995. HDFC was also a DFI, a development financial institution. Correct. So that was always kept separate for all these years. Correct. Any more comments from anyone? Okay. Okay, now maybe some Q&A or some thoughts from everyone here. What do you think is the role of a bank? I mean, what comes to your mind when I ask this question here in the auditorium to my friends and members here, that what is the role of a bank that comes across your mind when I say the word bank? Any thoughts? Sorry, somebody said lending. Custodian of money. Intermediary. Any other thoughts? Typically, I mean, if somebody would have asked me when I was doing my CA, I would say deposits and lending or deposits and advances. Correct? I mean, that was a simple answer I think I would give. Uh, Maybe to give you some perspective on,
They are in the business of trust.
correct, you're right. Sorry, Acha, you said that. Perfect, perfect. They're in the business of trust because they accept deposits from depositors. So they are the custodian of the depositors' money. What they do with that money is they deploy that money either in investments or as advances to other businessmen so that they can give some return to the depositors. Typically, if you look at European countries, frankly, I don't know whether you guys would have, I'm sure you all would know this, but where still some time back, before the inflation hit Europe, if a bank was putting money with BNP Paribas, we were charging them 25 paisa, 25 basis points for keeping surplus money in their account with us because it was a negative interest rate regime. Japan also is negative interest rate regime. Just, I mean, this concept just doesn't, it doesn't sound convincing. Just imagine you're placing 100 rupee with me and on top of it, you're paying me 25 paisa saying, please keep my 100 rupee. But now in Europe, that trend is changing. Even Europe has gone into positive now. So to give you some perspective, there was a guy last week from Paris and Belgium, and I was just taking him around meeting clients. His son's home loan is at 80 basis points, 0.8%. And finally, he's started getting money in his savings account, 0.2%. Finally, I mean, after God knows how many years. So he was happy that I'm going to get 0.2% on my savings account. So those are the markets. I mean, frankly, we are in a very, very different market where it has remained largely the same, barring 3-4% up and down. We have never seen those swings in the banking industry, so to say. So coming back to the main topic, correspondent banking business. A core bank, your clients may have told you this multiple times. You may have held your clients for making dollar payments, making euro payments, making JPY payments, making Saudi Riyal payments, and many more currencies, Singapore dollars, Hong Kong dollars, AUDs, and many other currencies. So what is correspondent banking business? Correspondent banking business is a transaction banking product. Now, what do you mean by a correspondent banking business? Any guess by anyone? So maybe just to give you some demystifying, it's a very, very simple business. Frankly, I was as zapped as you are on day one when I joined this department internally from Citi. And on day one, I was thrown by my boss in some RFP, which is request for proposal of CCIL, and I had no clue about what I'm doing. And I was sitting like till 12 in the night and calling people, can somebody explain me what I'm doing? And the best thing that I could do was I could change the fonts of that RFP and bring it to either Arial or a Times New Roman. There was nothing else I could understand. But to make it very simple, a correspondent banking business basically is something where a financial institution or a bank acts as an intermediary bank between domestic and international banks. Now, why a correspondent bank? An SBI or an ICICI or an HDFC, so why are you holding an account with a bank? You're holding an account with a bank on two counts. You earn some money and the bank is a clearing member in India, RTGS and NEFT. And because your bank is a member of RTGS and NEFT in India with RBI, you are allowed to transfer money from one bank to the other. Just imagine you have an account with a bank, but that bank is not a member of a clearing. So a lot of cooperative banks, to answer your question, are not even a member of clearing entity with RBI. So they can't even clear their own funds, leave aside doing exotic banking stuff. So they are not even having a clearing license from RBI. So they can't participate in RTGS NEFT, which is the basic thing that you would require when you're opening an account with them. Clear? So what happens is, for example, there is an importer. He bought goods from, say, US, or say from Germany, he imported a machine worth 1 crore rupees. You go to SBI and you tell them that I have bought this goods worth 1 crore, but the invoice is in dollar. Okay, the invoice is in dollar. and the total value would be say 100,000 or $125,000. How will the settlement happen? Just think and then tell me, and then I'll tell you why correspondent banking guys are there in picture, or why foreign banks like us are there in picture at the first place. Just tell me, you go to SBI, what will SBI do? Or what will an ICICI bank or an HDFC bank will do if you go with an invoice of $125,000 and say, I have an invoice, I have bought this machine, it's there at the port, I need to clear the goods and I need to make the payment. What will the bank do? Tell me with your request. How will the settlement happen? How will the dollar go to a foreign country like Germany from India? So typically a bank like us will come into picture. So correspondent bank, if you look at what the transaction banking products correspondent banks offer, is cash, payments, and trade. These are the two main pillars of correspondent banking. So an SBI has an account with JP Morgan, with Citibank, they're dollar clearing. So the way SBI is a member of RTGS and NEFT clearing in India, US banks, including BNP Paribas, is a member of CHIP and Fed in the US. So these are the clearing houses in the US. And only when I have an account with, or I am a member of this clearing house, I can do the clearing of dollars. So what will happen is SBI will come to me and say, Ki Vijay, you debit, I will open a Nostro account. Now what is Nostro? I have tried to give you the definition here. It's very simple. Vostro is an Italian word meaning yours, and Nostro is an Italian word meaning ours. So Nostro account means my account with you, and a Vostro means your account with me. So a Nostro account is always outside India from a foreign bank's perspective. So if I am a Citibank, if I have an SBI account and you go to SBI branch and you tell them I need to make this $125,000 payment, what they will do is they will simply send a SWIFT message. SWIFT is like telex. They will send a SWIFT message instructing Citibank, which is the correspondent bank here, to debit SBI's Nostro account with Citibank in the New York. Clear? I hope you're understanding the transaction flow. So there are 4 entities: importer, SBI branch, intermediary Citibank, SBI's account with Citibank. Citibank debits that account and credits. So if suppose the beneficiary in New York holds an account with Citibank, then it just becomes easier. It's a book-to-book transfer because it's not going in the clearing system. What I'm doing is I'm debiting one account. A Nostro account is like a current account in the US in a dollar-denominated currency. I hope you're understanding. I am trying to make it as simple as I can. So if it's a Citibank account with the beneficiary is also holding, it's a book-to-book transfer. But the moment the beneficiary is holding an account with JP Morgan, what will happen? Citibank will simply put that funds in the chip or Fed clearing. It's like RTGS NEFT clearing in the US, and it will get credited to JP Morgan's account of that beneficiary. So the beneficiary is holding an account, it will get credited there. This is a simple flowchart of a dollar payment that happens. Everyone with me? Or you want me to show it in a white slide and show how this entire thing works? So maybe if you see, I have the client of A is a sender, bank A is SBI, correspondent bank. There are many correspondent banks in the world. Okay, the top banks, correspondent banks are SBI, Bank of New York, Bank of America, Wells Fargo. Then so Chase is not a bank, JP Morgan. So JP Morgan basically does the banking. On Europe side, there are a hell lot of Canadian banks are there. Then there are European banks, Commerce Bank, Deutsche Bank, HSBC, Stancy, BNP, and so on and so forth. Very few have the dollar clearing participation, dollar clearing membership, because it requires a lot of money to become a member of chip and fed clearing. And then a lot of compliance, because I'm sure all of you would have heard about the word OFAC. Iran payments, Russia is now sanctioned by the US. So any payment going to Russia can't be sent through dollar clearing mode. I hope everyone has read that now Russia is sanctioned by the US from a clearing perspective. Iran was always sanctioned, Syria, Crimea, and there are a couple of more countries, Sudan, and so on and so forth. So these are the 4-5 countries which are barred by US in terms of dollar clearing. You can't send them. The moment you send them, the funds will be blocked and it will be kept in the reserve with the Federal Reserve in the US. So in this example, if you see Bank B, this Bank B can be the Bank A in the host, in the receiving country, or it can be some other bank. For example, in my example, it is JP Morgan. And then JP Morgan will credit the client of B. That's how the settlement will happen for an import payment. Everyone clear? Or do you want me to explain it again? So you guys want me to explain it again? Please tell me. So if you see sender, Bank A, here it is SBI. This can be Citibank. This can be Bank of America. This can be any bank who's providing dollar clearing. Then Bank B, which can be any bank in the US, correct? Where the beneficiary, this guy, client of Bank B is holding an account. He is the ultimate receiver of the money. It's very simple. A correspondent banking has 4 characters, 4 players in that entire flowchart. 1, 2, 3, and 4. And ultimately the receiver receives the money. Anyone, any doubts? A correspondent bank is somebody who has the ability to do clearing in the receiving bank's country. So to give you some perspective, ICICI Bank has their own target to clearing in based out of their Frankfurt branch. So if for a euro clearing, they clear euro clearing through their own branch in Frankfurt. So they don't need banks like us. They are members of their own themselves. They are the member of Target 2. SBI has a USD clearing license in the US, but they still use JP Morgan to clear the funds. Yes, yes, yes. Exactly the similar way they would register for an RTGS NEFT in India. Understood correspondent banking? This is the crux of correspondent banking. If you guys are done, I will tell you what more happens quickly. So when it comes to cash payments, it's a receivable now. I hope you understand if India is selling garments to the US, how the payment will happen. Exactly the same way, correct? I will get an export invoice where the exporter will come lodge the documents with the branch saying that I am exporting the goods and I will receive these funds, correct? And we all do reporting to RBI as a bank that how much of XOS is outstanding, the export outstanding list is sent to RBI. Typically the way it functions is the sender bank will credit SBI's account with a correspondent bank holding in the US. It's again chip and fed clearing which will happen. The moment I cite the funds, it is a job of the Treasury Department of SBI to convert dollar into INR and give credit to the exporter. It's as simple as that. Clear? Now to make it little more interesting, this is the traditional way of managing cash. The advanced. Many banks offer multi-currency solutions. If you're holding a dollar account with, say, a Citibank has a capability of making payment using a dollar account into 136 currencies around the world. So Citibank Treasury Department will convert dollar into that currency and they will make the payment. Alternatively, banks open multiple nostro accounts with multiple banks in multiple countries. That's what traditionally banks have been doing. To give you some perspective, when we met ICICI Bank, again, some 10 years back, and I was pitching them consolidation. I was pitching them liquidity solutions. I realized that as ICICI Bank India, ICICI Bank Singapore, Hong Kong, Dubai, Canada, all put together, they had 135 nostro accounts. And if I were to just look at the liquidity which is lying in those 135 accounts, it was running in millions of dollars. So what I proposed to them was notional pooling, that the money will be pulled from one account, it will come in a main master account and you will earn more money and all of those things. So that's a liquidity solution which Correspondent Bank provides on the surplus money left in the nostro account overnight. You're getting the point. I mean, just imagine a nostro account is like a current account of SBI with Citibank. Citibank provides a statement to SBI on a daily basis. And it is also available on a real-time basis on a click of a button. The way you see your savings account, the way you see your client's current account, banks see their nostro account online on the portals of these correspondent banks. So that's the float at the end of it. And on float, banks, depending on the Federal Reserve rate, which is quite high now, they provide an overnight interest rate to these banks to keep money overnight with us. So what happens is typically there is a sweep in which happens. The moment anything more than $100,000 is kept in the account, I have an arrangement with the bank and I'll tell them that if 20 million is remaining. So there are a lot of inflows, outflows which keeps happening. It's a very complicated nostro account. Just imagine SBI will have how many importers? SBI will have how many exporters? किसी का लड़का लड़की is going to US for studying, Europe for studying, Canada for studying, Australia for studying, their payment. So all these are the tuition fees. Some expat is going, his salary. So there are a lot of foreign exchange transactions which happens through the nostro account. And at the end of it, whatever balance remains is kind of swept out by the correspondent bank and they get some extra money for that, because then the bank will invest it somewhere in some other country and then we pay them overnight sweeping charges. Everyone clear? So multi-currency possible, multiple nostro accounts possible, multiple currency possible. किसी को सिंगापुर डॉलर में भेजना है, can send it. किसी को ऑस्ट्रेलियन डॉलर में भेजना है, भेज सकते हैं. Then they will open, SBI will open their Australian dollar nostro account with ANZ or Westpac. Clear? If they want to open a Singapore dollar, what name comes to your mind? DBS Bank. Clear? If they want to open a Euro account, I provide that. So it's in Euro. Clear? Dollar, top US bank, Standard Chartered does that, Deutsche does that, and they also have dollar clearing despite not being a US bank. Correct. So that tie-up is happening. So what RBI has done is to, I don't know, I mean, not many may be aware, but RBI's reserves had touched over $650 billion, which was the highest ever in the history of RBI that we had so much of forex reserves. It is now down to $560, $570 billion. Huge. We are number 3 in the world when it comes to forex reserves. We are that big. We are very substantial when it comes to the forex reserves. So what is happening is RBI has come out with a new, not regulation, but a new mechanism for doing settlement of cross-border transactions. So if somebody wants to do a settlement, not doing a cross-border transaction, I can do the settlement in INR. But the other guy needs to agree to that. For example, we are now buying a lot of oil at subsidized rate from Russia. A lot of Russian banks have opened their Vostro account with us. So coming to this, a lot of Iranian banks have opened their Vostro account with United and with IDBI. Sorry, with UCO Bank and IDBI. UCO Bank has a lot of, no. Union Bank will, UCO Bank has Vostro accounts of all of Iranian banks. No, they have Vostro branch, but they are not allowed to open, because what happens is the moment any bank opens a Vostro account of a sanctioned country, banks like us will chase them. We will stop our dollar clearing with you. So what happens is typically a Vostro account is opened, like BNP Paribas has a Vostro account with BNP branch in India. I can alternatively open a Vostro account with SBI. So for SBI, it is a Vostro account, but SBI's Nostro account is with BNP in Paris. I hope you're understanding the difference between the two. Vostro is a foreign bank's account with the host country or with the host bank in India, which is SBI. So for SBI, BNP's account is a Vostro account in INR. That is Vostro account. Now what happens in Vostro account? Again, the same thing. If my clients want to remit INR in India from Paris, I have two alternatives. Either I convert it myself into INR by sending dollar here, or I give dollar to an SBI and tell them you convert. But why should I give them that benefit of earning foreign exchange? So that spread I'll earn. And I'll take euro from Paris, convert it into INR, which is BNP branch, and simple RTGS NEFT into SBI's account of that client, of that Vostro. And then SBI will further do a simple RTGS and NEFT of the domestic clearing. Everyone clear on what is Vostro account? So Vostro account is a foreign bank holding an INR account with an Indian bank. A Nostro account is an Indian bank holding a foreign currency account overseas. Everyone clear? Or you want any more examples to understand this better? I'm sorry, I think I will overshoot the time, but any doubts? Okay, quickly coming to letter of credit. Do you guys want me to go through the nitty-gritties of letter of credit, or everyone is aware of what is letter of credit? Yes, please. So what happens is there are few. Perfect. So Saraswati is having a dollar account with Wells Fargo Bank, and they also have a Nostro account with Standard Chartered Bank. So these are the only two banks which are doing dollar clearing for Saraswati Cooperative Bank. But to answer your question, what these banks do is they typically look at a partner bank. Okay, so typically it's a business opportunity for a domestic bank. Like SBI very smartly will say, I have a Nostro account with Citibank. You give your dollar payment to me, I'll earn some spread in between and I'll transfer it through Citibank. I'm forgetting the term that is nested account. So it is called as nested account. I now remember. I mean, I used to do dollar clearing many years back. I don't do it anymore, so I had forgotten the term, but it is called as nested account. A nested account is where it is not the direct customer's flow of a bank, but it is a customer's flow which is routed through a Nostro account. It is very dangerous because what happens is typically SBI will do a simple transfer. Now they have become smarter and they ask for documents, give us import bill, give us import copy, give us KYC documents and all those things. But earlier they used to just be little greedy. कि यार पैसा आ रहा है cooperative bank के मेरे को $200 दे देगा एक transfer में, let's just earn money. But then I just don't know किसका flow है. So as a correspondent bank, why it is very dangerous to be in this business? To give you some perspective, very startling figure, BNP Paribas has paid fine of $8.9 billion in 2014, which is, you know how much? 50,000 crore of fine to US regulator for violating OFAC sanction. So what we did was, I think there were few payments we sent to Sudan without even realizing, because see, being a French bank, I think these guys may not have been so robust as compared to, I think, US banks. And I think somebody played foul. So what typically happens is, I mean, how you catch that there is Sudan, okay? When you send a SWIFT, you will write Sudan. But if you don't write that, and it is actually going to Sudan, nobody will ever come to know. But then these guys catch it in the screening when it goes to the US, because US is a gatekeeper. And we paid 50,000 crore of fine. And since then we stopped dollar clearing business for third party. We said we don't want to do it. You earn not even $1 million, but you pay fines in billions of dollars. So there is a lot of AML, there is a lot of risk which is involved in a correspondent banking business. So many banks are prone to this. So it's not a very simple business to be in, but you need to have extremely strong, robust controls when it comes to compliance and AML. Your screening should be completely, I mean, to give you some perspective, there are many a times the payment is made and it never reaches the beneficiary because it gets stuck for more information in the US. To give some numbers, Federal Reserve has $600 billion worth of transactions which they have stopped and they have not processed. They are sitting on so much of liquidity of somebody else's money because those are all sanctioned country payments. Everyone clear? Quickly on documentary credit cycle, there is a very simple why an LC has come into picture. Very simple. If I am selling a watch, say to Pinky ji yahan pe, and we both know each other, we have trust. I'll give a watch to her, she'll pay me the cash or check or an online transfer against it. And the settlement happens then and there. Just imagine, I want to import a machine from somebody in Germany. Correct? What are the two ways this transaction will happen? The guy will say, first make the payment, and then I will import the goods or ship the goods or ship the machinery. I'll say, are you thinking I'm a fool? You first send the machine and then I'll make the payment. What is the risk here or what is the problem here? Both sides don't trust each other and they don't know what to do. That's why something which is called as letter of credit is there in the picture. What happens with a letter of credit is the importer goes to a bank and the importer says that I am importing this machine. This bank, SBI, will issue a letter of credit to a bank in Germany, say Commerce Bank in Germany. The guy knows Commerce Bank because he's having an account with Commerce Bank. Commerce Bank will confirm the letter of credit saying, I know SBI and I have limits on SBI. And the moment Commerce Bank confirms it, the risk shifts from SBI to Commerce Bank in the domestic country. The guy happily sends the goods. As soon as depending on site LC or Usance LC, the payment is made by the guy from here. Again, the same model, the payment which we saw that flow chart. The guy receives the payment and the letter of credit serves the purpose. A letter of credit is a non-fund based funding facility. I mean, there is no financing involved, a bank guarantee and a letter of credit. So what Correspondent Bank does, they sell network. The bigger the network, global network you have, the brighter are the chances that you will become a correspondent bank. BNP is present in over 60 countries. Citibank is present in over 90 countries. So the more the number of banks, and then correspondent banks have tie-ups with further foreign banks in local countries. So what happens is typically if I don't have a presence in a local country, I will tie up with a local bank there. And then this is just an extension. And that's how the payment is made. That's how the LC is confirmed or issued. I mean, frankly, all of this kind of requires a day. If I were to kind of give you a perspective on how a letter of credit functions, there are multiple ways of letter of credit, how a financing is done, how a supplier's credit can be structured. I mean, for a simple example, an LC, there is a structure which is called as Usance payable at site, UPAS. The way it functions is the guy doesn't want to pay immediately. So a correspondent bank like we will come into picture. I will ask SBI that you issue a site LC. You issue a Usance LC, but it is payable at site. So the moment that LC hits our counters in Paris, I will discount it, make payment to the beneficiary, to the exporter there on day one. And on the due date after 90 days or 180 days, SBI will make the payment to me along with interest. So these are the simple off-balance sheet financing options for importers. Because for importer, in his books, it's a Usance LC. So he will continue to show it as notes to accounts. I mean, he will say, I mean, it's not correct. So the LC that will be issued, it will be basically an unfunded. Correct. That's a trade payable after 90 days. So these are the structures which are very, very prevalent and I think this is limitless, frankly, if I were to give you some perspective on LC, but did you kind of understand? I hope you understood the basic of LC. Coming to my last slide, I know I am kind of in between you guys going home and this. So coming to the financial institutions coverage, transaction banking is one product of financial institutions coverage. Now, the 4 points that I have mentioned are the 4 main pillars of a financial institutions coverage. The first, so I am a coverage guy. I don't do any work. My job is to manage relationships. So my job is to ensure that the financial institution is happy with my bank. Clear? I'm a coverage guy. So my job is to only cover the relationship. I don't sell any, and I sell products. But the fulfillment is done by these product partners. So I have product partners in my bank with whom I go pitch, and my job is to ensure that we get the business from banks, from non-banks, from insurance, from mutual funds. Like I'm onboarding the mutual fund business customers now. So I have to make a business memo and give it to my credit, my business manager, and they will approve onboarding of these names. Transaction banking, everyone understood? Receivables, payables, trade loans, and liquidity management. Liquidity management is the sweep in, sweep out of the surplus balance which is there. Now that is for the cross border, but a transaction banking in domestic business is a big business. It's also done by a lot of private banks. For example, if I am, say, an insurance company and I have 2000 outlets, typically when now things have changed, people will do an online transfer for their LIC premiums or say for their mutual fund SIPs. पहले तो सब cash में देते थे कि ये मेरा ये महीने का SIP है. So the cash will go to a particular branch of that mutual fund entity. Now, who will collect the cash? Who will deposit it? Who will provide an MIS? That's where the transaction banking has evolved. Citibank used to be a pioneer many, many years back in early 2000, late 1990s. Citibank was the first bank. I mean, Citi has done many firsts. Credit card Citi was the first. Auto loan Citibank was the first. Personal loan Citibank was the first. Transaction banking, we were pioneers. And we were completely out of box thinking. So what we used to do is, very smartly, Citi only had 40 branches in the country. But Citibank tied up with all PSU banks and private banks in the country. And even before PSUs could understand that they are riding on our network, Citibank used the network of partner banks and started providing transaction banking proposition. For example, a Tata Motors, they will have outlets of their trucks across India. There will be a lot of dealers. They will require financing. So dealer financing was something which Citibank used to do. Then what will happen is there would be a lot of EMI that will get collected. There would be a lot of checks which will get collected. All of this was done by a transaction banking team. It's a product of the coverage. So I will manage Tata relationship or Reliance relationship or JSW or whatever you call it. So we have a corporate banking team also. So the coverage are largely three verticals in any bank, in any foreign bank. One is financial institutions coverage. Guys like me manage financial institutions. Then there is multinational companies. Our parent domestic companies, when they are setting up their shop in India, Colgate, then Amazon, Netflix, all these are multinational companies in India, correct? So their accounts we will manage. And we will provide them funding, we will provide them transaction banking, we will provide them treasury and everything. And the third vertical is a large corporate vertical. These are the three coverages. And then there are these four products for all the three coverage businesses. Clear? Now coming to the domestic cash management, it's again, there is limitless. There are multiple solutions for multiple customers for their multiple requirements. If somebody says, Vijay, I want a dashboard in my system for all the collections that has happened today across all my stores or across all my branches across India, how much we have collected, how much we have paid, how many checks collected, how much is in clearing, how much is already cleared, all that transaction banking team used to do. And they still do it. So transaction banking is a huge fee-making business. So for every check collection, we will charge maybe 20 rupees, 10 rupees, 5 rupees or whatever. But now given that a lot of things are now becoming digitized, the pure play is now on liquidity management. On a current account, typically, if the money is left behind, a bank earns close to 5%. So as a bank, I'm very happy if somebody leaves their surplus behind in the current account at the end of the day. Because current account, nobody pays any interest. I hope you guys are aware of this particular thing. Now, trade loans is something which I provide to banks. Now, you will, when I tell somebody that I give loan to SBI, people laugh at me saying, I mean, what is your size? What is their size? But in India, I may be small, but in my home country, I'm much, much larger than SBI. All put together, we are a $2.5 trillion balance sheet, which is huge. So we provide dollar liquidity, euro liquidity to SBI in their overseas branches. So for example, SBI in their Singapore branch want dollar. SBI cannot originate dollar on their own, correct? They would need a partner bank like us to provide them dollar liquidity. And this liquidity is something which foreign banks provide. So we provide trade loans for the trade transactions that SBI does. So if SBI importer comes and says, can you please give me $1 million for this machine payment? I give that 1 million to SBI, and SBI will do a markup, and they will give that 1 million to the exporter when they are making the payment. All clear here till now? Global markets. I mean, it is bouncer for me also, just goes above my head, but I work very closely with global markets in my current role because 80% of my revenues is global markets. So I spend a lot of time with global markets. What they do, there are institutional sales people in global markets. Again, global market is a very, very unique setup. One is the institutional sales guys. They manage banks for their global market requirements. Then there would be corporate sales team. They would manage the corporate clients and MNC clients. And then there would be a trader. So a trader's job is to manage the positions which these guys are taking. So the way typically, I don't know whether you have seen a global market shop floor or not, or the office or not, it's chaos. The guy shouting from there, 80.2, the trader will say, okay, done. So he will just give that quote online on Bloomberg or Reuters to the guy in say an HDFC bank is asking for a quote. So for example, there are a lot of hedging opportunities, so which is called as cross currency swap. There are principal only swap, and there is interest only swap, or there is a total cross currency swap for the entire principal and interest. If a client in India is taking say $1 million loan from overseas party, the risks involved is what? The currency risk, because the currency may depreciate or appreciate. The second is the interest rate risk, because the interest rate also may go up and down. So as a bank, BNP provides the hedging solutions to these customers, including banks. Now, why will bank do a hedging with me? No bank in India can do every global market transaction on their own. Everybody wants to dump their risk on somebody else's head. So the way a global market functions is, if an SBI has done a 5-year, $500 million ECB loan for a client, they are giving a hedging solution to that customer. Back to back, SBI will do that hedging with us. And my trader will do a sell down in the market unless he thinks that I can keep the position. Clear? I mean, in very simple terms, I'm trying to explain you guys how the global market office functions in any bank. So these hedging is something which is done under FX. FX is simple foreign exchange, INR, dollar, cross currencies. Rates is if you have an exposure in variable currency, suppose you have taken a SOFR loan, or you have LIBOR is no more in practice now, but if you have taken a say a GSEC linked loan and it is variable in nature or it is fixed in nature. So typically you can do a interest rate swap with us. If you feel that there is a possibility that it may go up in future, like if 1 year back, if somebody would have said that the Federal Reserve will not increase the rate, everywhere it was writing on the wall that they will increase the rate. So many clients took interest rate swaps. So they are blocking their variable into fixed component. That is interest rate swap. Clear, everyone? Then comes repos. Now repo is again a very, very unique product where if I have GSEC with me, or I have a bond, a dollar bond or any other currency bond in the overseas branch of a bank, I'm just holding the instrument in my hand, correct? I can leverage it. What I'll do is I'll repo that security to a bank like BNP, and BNP will fund by doing a haircut, a 5%, 10%, depending on what is the quality of that bond or that instrument which the buyer or which the borrower is giving. If it's a corporate bond in India, then we will typically have a very high haircut, and we will fund them against the pledge of those securities. And it's not actual pledge, but it is just earmark. So that's repo. Placement is somebody having ample liquidity, dollar, because see, INR liquidity, again, we do under the ALM. Okay, the asset liability management team, if I want to borrow INR overnight from a bank will borrow from a bank in INR. That is in domestic. But overseas, I can provide a very attractive return. So there are two ways you can park your funds. You can park your dollar funds with Federal Reserve, or you can park the fund with a commercial bank, a foreign bank like us, and we will pay you little more than what a Federal Reserve will pay you. That is placement and money market. A money market is short-term borrowing, 1 day borrowing, 7-day, 30-day borrowing to match your short-term balance sheet mismatches, which banks borrow from banks. Clear? Capital markets, very interesting. You may have read in the newspaper, INR 81, SBI raised at 8.6%. Last year, Axis Bank had raised close to $750 million under $81 under the sustainability structure. So we were part of that bond. We were part of the SDFC bond also. And SBI did the INR 81. So ECM is equity capital market. It is part of the investment banking product. So we go and pitch for various solutions. So what we do is we basically go to the balance sheet of the bank and we tell them that liquidity is available at this rate. If you want to issue your QIP, it is a qualified institutional placement. So a lot of banks issue QIP. When COVID hit, banks like ICICI raised close to $1.2 billion from the market under QIP. We were part of that mandate. So what typically happens is we bring investors from the market. Okay, we are the BRLMs. We are the mandated lead arrangers for that particular issue, and we get investors for the banks. So our investment banking team is actively involved. As a FIC, what I do is I get that mandate for the investment banking team by pitching, by showing them presentations, showing them market, showing them color on pricing, getting investors, international investors, hedge funds, long investors, short investors, and then we try and convince them that we will get you good investors. You please take us in your equity mandate. All clear on this? So typically what happens is Indian banks don't pay. They pay very, very minuscule, but if I am on an SBI's mandate, my league table ranking improves and smaller banks can pay me more. I can go to a smaller bank and say, see, I was with SBI, now you have to take me because my ranking is 3, my ranking is 2. So everybody is kind of fighting for that ranking. But to answer your question, it is hardly anything. It's hardly anything because every bank is dying to be a part of that mandate. It's like everyone wanting to marry the same person at the same time. So then that person has a lot of options to decide. Coming to DCM, debt capital market. Now, debt capital market is again something which are of two types. One is there are multiple types. There is Formosa bond, there is Reg S bond, which is listed on Singapore Stock Exchange. There is 144A, which is listed on the US Stock Exchange. So these are the bonds. These are tradable bonds in dollar currency, which are issued by banks like us for banks in India. Even an NBFC can raise funds under DCM through banks like us. So what we do is they need to basically look at a framework. We help them make that framework. And then what we do is we get the bonds listed, okay, in Singapore Stock Exchange or US, depending on the size, at a particular price. So it's simple as a debt borrowing, but it's in the form of a bond, which is tradable. So DCM is something which again is done by our DCM team in the region. And the last one is M&A. For example, HDFC is an M&A. If an NBFC wants to acquire another NBFC, we will show them ideas that this is a good NBFC. This could be a good match for you in terms of the asset quality, the capital, the portfolio structure and everything. And then comes the last. What we do in PIC, we provide loans bilateral basis, a syndicated loan, which is a structure where 3, 4 banks come together and do a syndicated loan facility for a bank. For example, SBI has done $750 million of syndicated loan facility. They have done a Formosa Taiwanese investor bond. So when they issue a bond, when they issue a syndicated loan, then there are secondary players who come into picture, and then the primary guys offload that loan to other smaller banks in the market. That is syndicated loan. So the idea is basically, I mean, reducing risk is one main criteria, but the whole point is even SBI wants that I don't hold the entire 200 million in my books. Because if I do that, then I may not have much limit on SBI when they come to me tomorrow. So they want me to defease, they want me to distribute the risk so that my limit, SBI's limit with us keeps kind of coming up again and again. And the last one is ECA. It is Export Credit Agency. Sorry, a club is, which is not a syndication, where 4 banks come together, a 500, 125 each, all 4 banks fund, and they just keep it in their balance sheet, keep it in their books. That is a club loan. Multiple banking. It's like a consortium arrangement, but where it's all pre-decided that which banks will come together. If suppose SBI wants to borrow, say 500 million, and they want to borrow privately. So they will just basically say 500, I may not have full appetite on SBI at that point in time, say for 3 years or 5 years. I will call 3 banks, or SBI will invite 4 banks, like-minded banks, and they will say, if you all are okay, let's make a club loan agreement, and you fund under this club loan agreement to us. What is the benefit for SBI? They get everything at one shot. They need not do multiple bilateral loan agreement with many banks. So a club is something which you do only one agreement with all the 4 banks in it. Clear? And the last one is ECA. It's Export Credit Agency. Now what happens here, again, very, very interesting. The way typically it functions is a World Bank or an IMF, or like World Bank now, there is a project on Clean Ganga. And all these multilateral agencies, they don't have money. Correct? I mean, if you think World Bank doesn't have money, World Bank doesn't have money. From where they will raise funds? Correct? So what they do is, they come to commercial banks like us, large banks with large balance sheets. And they will say that Clean Ganga project requires, say, 5,000 crore of funding. You fund, I'm guaranteeing this loan. So what happens is, the risk rating changes from a local borrower in India to a World Bank, which is a 2-rated or a 1-rated agency. So World Bank is very smartly just lending their name, guaranteeing the risk, which is very, very critical in a lending business. And we fund them. Similarly for an Asian Development Bank, an ADB bank. Then there used to be an OPIC in the US. They have changed the name now. It's some DIFC or something is what they call, DFIC or something. So all these multilateral agencies, they guarantee the loan, but it is funded by a commercial bank. And those are Export Credit Agency financing. For example, for Shriram Transport, we did one ECA loan, which was guaranteed by SACE. It's an Italian government agency. So I did that loan, which was 85% guaranteed by SACE. 15% was my clean exposure for 6.5 years. But the comfort that I get is that 85% of my loan is guaranteed by a government entity. And the thing is, that entity didn't give even $1 or €1 in that loan. Everything was given by foreign banks like us. So ING gave half, I gave half. But the comfort that we had was that it is guaranteed by. So these are all multilateral agency guarantee-backed financing. It is called as ECA, Export Credit Agency. I think I've taken a lot of time. Sorry for that. But thank you.
If you have any question, you can ask him.
Thank you so much. I really appreciate your patience.
Yeah. At the outset, I want to thanks Vijay ji actually for accepting my invitation to speak on this subject. Actually, when I met him and I asked him about his profile, it sounded very interesting and unique for me as a practicing CA. So at that moment, I thought there should be one seminar or on this subject, and all the CA should get the benefit of that. So thank you, CA Vijay ji, to accept my invitation. And because this subject is very unique, I was frankly speaking, there was fear in me कि registration आएगा कि नहीं आएगा. Chairman से गाली तो नहीं सुनने मिलेगी, कुछ भी रख लिया, बच्चे कोई registration ही नहीं आया. But for your information, we have 130 registration for that subject. So thank you all for coming, registering the subject. And now I want to invite CA Vijay Vakharia to give a formal vote of thanks for our today's speaker.